All right, well, hello everyone. Welcome to the Voluntary Carbon Markets Symposium, co-hosted by the Stanford Rock Center for Corporate Governance, the Stanford Steyer Taylor Center for Energy Policy and Finance, and the new Stanford Doerr School of Sustainability. I'm Sam McClure, Director at the Rock Center. Before we get started, I'd like to thank the Rock Center team, in particular the programs team, for their assistance coordinating today's events, as well as the speakers who have generously volunteered their time to join us and share their perspective. Voluntary carbon markets have been a hot topic recently with fast developing dynamics, regulatory scrutiny, and as many of you saw on John Oliver, even some mainstream news attention. We have an ambitious schedule today covering voluntary carbon market history and context, theory and practice, and some predictions for what the future might hold. In the first session, Amy Ban at Expansive and Francis Seymour from the World Resources Institute will discuss the 25-year history of voluntary carbon markets and ground us in the overall context for today. Second session is a conversation between Mark Roston and Alicia Seiger from Stanford's Steyer Taylor Center about potential limits to scaling carbon markets as currently structured and how we might think about necessary solutions. We'll then have a short 5-minute break followed by our third session in which Paul Barker from Kirkland & Ellis, Marianne McGarris from Veritree, and Luciana Aquino Hagedorn from NCX will discuss current business and legal issues presented to buyers. In other words, how can corporate actors make wise decisions when buying carbon offsets? Finally, a conversation between Marie Atch from PricewaterhouseCoopers, Mark Phillips from McKinsey, and Danny Cullenward from Carbon Plan discussing internal corporate governance, organizational incentives, reporting, and how these issues in the market itself might develop in the future. Q&A will be available via the Q&A feature, so please feel free to add your questions there. Time permitting, the speakers will address a few questions at the end of each session. Our first two sessions are just 30 minutes, though, so maybe less time for Q&A. A reminder that today's programming will be recorded and made available online. All right, so without further ado, I'd like to introduce Amy Ban and Francis Seymour. Amy is an executive and board director with a focus on ESG and climate markets and innovation. She currently serves as head of supply and ecosystem at Expansive, the leading ESG trading exchange for carbon, fuels, water, and renewable energy. She served on the task force on scaling voluntary carbon markets and on the United Nations Climate Talks Aviation Industry Delegation. Previously, Amy was the director of strategy at Boeing. She'll present a few slides, and then we'll hear from Francis Seymour, who is a distinguished senior fellow at World Resources Institute, as one of the world's foremost authorities on sustainable development. Her extensive research, leadership, and management experience has given her deep understanding of the environment-related opportunities and challenges facing developing countries. Francis is also chair of the board of the Architecture for REDD+ transactions, which manages a standard for jurisdictional scale tropical forest credits. So thank you, Amy, and then Francis afterward, turning it over to you, Amy, for an overview of the history and context of carbon markets.
Thank you, Sam. Great to be here. Good morning to everybody. So yeah, I'll share a brief overview of the market and then pass it over to Francis for some great context. So what is the voluntary carbon market? It's a private sector mechanism to fund projects that reduce emissions. So this really is different than a compliance market in the sense that it's not mandatory. Companies are choosing to take action on their own. A lot of times this is for emissions they can't directly abate, so it might be due to supply or technology limitations. And Francis will talk more about this in a few minutes, but one of the big drivers here is you've probably heard about corporate commitments and targets. A lot of companies have set a net zero goal or other certain years, or they're intending to bring down their emissions. And there's a lot of emerging guidance that's helping bring clarity to them on how they do that, as well as potentially regulatory requirements, such as the new SEC climate disclosure rules. Francis is one of the world's best experts on the Science-Based Targets Initiative, so you can hear more from her in a little bit on that. Voluntary Carbon Markets Initiative, for example. So these are some of the key drivers. As well, there are global frameworks and initiatives, different programs and policies that drive this. CORSIA is the aviation sector's program hosted in the United Nations that I got to participate in helping craft. The UN programs also play a key role here in that they govern the jurisdictional programs at the country level, and that integrates with the voluntary market. And currently, the Integrity Council for the VCM is undertaking a pretty big initiative to put out the core carbon principles. That's currently they had a public consultation this past summer and fall, and they'll be releasing and publishing their next iteration pretty soon. So how big is this market? We're right at about over 2 billion. If you look at the end of last year on this chart, and we don't have 2022's full numbers yet, but that'll be out at the end of the year. It was just under 2 billion and 500 million tons. So that gives you a sense of the scale and size and the growth trajectory that you can see from the chart. And the different components are growing very fast as well. So both on volumes, on the values traded, and the number of organizations getting involved in the market and participating in the market, all are moving forward at a pretty rapid pace. As well, I'd like to touch on infrastructure. So in a maturing market, you see different types of financial transactions start to emerge. And in the past 2 years, we've seen quite a bit of that in this space. CME Group has a futures trading and derivatives set of products around carbon. My company, Expansive, has a spot trading market. And so you can go on there and do project-specific trading. S&P Global Platts does price publishing and price assessments. And that's a really key part where others look to that for guidance and benchmarks. There's still over-the-counter trading and bilateral exchanges happening as well. And then the standards and registries are a really key part of credibility and that certification piece. And I thought I'd share this slide. So historically, it often would take markets up to a couple of decades to get through all of these steps. And I won't talk to each of them, but essentially, it takes a while to develop the right market sophistication and tools to get it down to that bottom row. That's actually where we're at today in the carbon market. You're seeing long-term contracts, you're seeing benchmark pricing. And so just thought I would share that as a context for how this normally develops in markets. This is just a quick screenshot of what our trading screen looks like. So you can see, you can select by project and attribute. You can pick your certification, pick your type of project, search by region. You can click in and get very specific project documentation. So it's really becoming quite sophisticated. And then we've also created benchmark contracts, and this is important in the market too. Purchasers can then procure high quality credits at bulk. They can use this in other ways as well to mark books and structure offtakes. And it's kind of interesting, if you look at the turquoise line, you can see that it's ticking up as a % of the overall market. So a lot of buyers are increasingly looking at these more sophisticated type of ways to do their purchasing. Another quick screenshot just to show you what this looks like. So you can go on screen, there's bids, there's asks. It's becoming much more standardized than it was a few years ago. And this is a great scatter plot chart that shows you the effect that has on pricing. So as benchmark contracts emerge in the market and it's maturing, that, for example, the white line, the white dots are the nature-based credits, which are commanding a premium in terms of pricing trends we're seeing right now. The others are pegged to CORSIA, which is the aviation standard, and technology credits. But if you look at the blue dots, those are specific projects. They're all starting to move along with the benchmark contracts. So we're really seeing the maturing of the market here and the way the pricing is starting to work by segment. Just backing up for a moment, what are carbon credits, carbon units? Everybody has different understanding of what that is. I think this is a great chart from Ecosystem Marketplace that lays out the different types. And what I would add to this is, as innovation is continuing to emerge and evolve, we'll see more and more types added all the time, which is really great. In categories, so you've probably heard about reduction versus removals. Wanted to share this chart as a way to visualize that. But the way that I often think about this is it's not an either or type of debate, and it shouldn't be. We need to be scaling up multiple solutions all at once with a sense of urgency. And it's actually good to have a range of options and price points for different buyers. In quality, I think this will come up later in your day as well. Very important. The way we handle that at my company is to use third-party certifiers. The standards play a critically important role in making sure that they're validating and auditing these credits as they are issued by them. And then recording those asset life cycles. Our company, APX, offers registry services, as do others. And it's critical that those projects are tracked throughout their entire life cycle. And Francis can talk more about this, but carbon projects and ESG reporting, wanted to note that they're not the same thing. There's always a physical project that underlies that ESG attribute, but it's not the offset itself. That's more of a carbon accounting term. So I won't get into detail there because I think Francis can speak to it, but really important concept to separate out the project and then later how it is used in greenhouse gas accounting. And here's another great way to visualize that. And I'll close with this slide because Francis is a great person to talk about nature-based. But essentially, you have a development of a project. That's the physical asset. You have the ESG attribute, which is that CO2 capture. You have measurement of that, the CO2, and then you have that digital asset, whether it's the issuance of a credit or offset, stem from that. So I'll close there and I will pass it on to Francis, who is one of the world's top leaders in the context on forestry and pass it over to her.
Great. Thanks, Amy. And let me share my screen now. So first, thanks to Sam for including me in this symposium, and thanks to Amy for giving us such a complete and concise Carbon Markets 101 introduction. My role today is going to say a little bit about how this whole picture relates to nature, and specifically forests, and even more specifically tropical forests in the international carbon market, and just go through some of the opportunities, myths, and challenges related to that. So the structure of my presentation will be to first elaborate the many benefits of including nature-based and especially forest-based credits in the carbon market. Then identify and try to refute 3 myths about forest carbon credits, and then deal with the so-called John Oliver problems that Sam alluded to in his introduction. So the voluntary carbon market is growing quite rapidly. Amy also showed this figure from Ecosystem Marketplace that shows this dramatic jump in 2021. And as one of her other slides suggested, one of the main reasons for that jump in the value of the voluntary carbon market is an increase in transactions and price for nature-based credits in particular. And that demand is expected to continue to grow as more and more companies set climate mitigation targets. And that's a good thing if we can channel that demand into finance to capture a number of opportunities, which I'll describe now. So the most important opportunity is to halt and reverse tropical deforestation, which is one of the most significant climate challenges that we face as a global community. This figure on the left side of the slide shows that if tropical deforestation were a country, it would rank 3rd after China and the United States as a source of global annual emissions. The pie chart on the right shows that, on net, deforestation contributes about 11% of annual emissions, or about half of the emissions from the overall land sector, with agriculture taking up the other half. So this is a globally significant problem, and according to IPCC scenarios, there is no way that we can meet the temperature goals of the Paris Agreement unless we not only halt, but reverse tropical deforestation, and do it within this decade. However, there's a big gap in finance. And even though you may recall last year at the Glasgow climate negotiations, more than 100 heads of state stepped forward to commit to halting and reversing deforestation by the end of the decade, they're not going to be able to do it without financial incentives and wherewithal. And it just so happens that Climate Focus released a report just yesterday, the Forest Declaration Assessment, that looks at where we are and how far we have to go in following through on these commitments. So this is their analysis of the finance gap. On the left, we have bar charts showing the little gray bar is the total business as usual finance going into forest protection and restoration in the relevant tropical countries. The tiny little sliver in green is the green finance going towards that objective. So financing for REDD+, reducing emissions from deforestation and forest degradation. And the tall blue bar is the range of estimates of how much finance is needed annually to actually meet that challenge of halting and reversing deforestation. And the figure on the right basically just unpacks the little green sliver over the last 12 years in terms of where that money has come from. But basically the takeaway from these figures is that the green finance going towards the objective is an order of magnitude smaller than the environmentally blind finance, which often actually drives deforestation. And that little green sliver is up about 2 orders of magnitude lower than a mid-level estimate of how much finance is needed. So if the voluntary carbon market can help close that gap, that would be a really good thing. But that's not all, because it turns out that forests affect climate stability in ways other than through the global carbon cycle. And also just yesterday, World Resources Institute produced a report that I led on the policy implications of these non-carbon climate benefits of forests. The figure on the left gives some simple illustrations of what these pathways are, things like, albedo and evapotranspiration, and how the rough surface of forest canopies mix up the wind in ways that lift heat and moisture away from the Earth's surface, and also the effects of small particles and compounds that help in seeding clouds, which reflect more of the sun's energy, all with some non-trivial effects on the climate across scales. And the bar chart on the right shows how the green part of the bar is how much annual mitigation could be attributing to halting emissions from tropical forest loss through the global carbon cycle, close to 3 gigatons of carbon dioxide. But the blue represents the additional planetary cooling that you get from tropical forests through those same mitigation actions. But that's not all, because of course, forests also have many non-climate benefits, which include harboring the vast majority of terrestrial biological diversity, providing a lot of non-climate ecosystem services like maintaining water quantity and quality, and also being really integral to protecting the rights and livelihoods of indigenous peoples and local communities who, of course, not only depend heavily on nature, but also are on the front lines of protecting it. However, forest carbon credits and nature-based credits more generally have had trouble being accepted in carbon markets for a number of reasons. And some of these are myths that I'm going to try to quickly dispel. And the first one is that nature-based credits are inherently inferior or of lower quality than technological solutions. And some of that bias dates back to the early days of carbon markets and the clean development mechanism, when at that time, it's true, our ability to measure even deforestation, much less the emissions that came from it, was pretty primitive. But since then, we now have satellite imagery and other remote sensing technologies, which result in our being able to construct maps like the one on the right of global forest carbon fluxes that are increasingly sophisticated and getting better all the time. And yet, the forests and other nature-based solutions are still penalized in the market and often are held to a higher standard of managing risk than other kinds of carbon credits. But the reality is that those risks, things like uncertainty, leakage, non-permanence, non-additionality, are not unique to nature-based credits. And in fact, this chart on the right is from a WRI working paper where we give an example of those kinds of risks for technological climate solutions. And so the point is that no carbon credit is free of risk. You just have to be sure that the options for managing those risks are being implemented appropriately. And furthermore, all those additional climate benefits that I mentioned from forests aren't taken into account. So you could argue that forest-based carbon credits are more likely than not conservatively credited compared to other kinds of technological carbon credits. Second kind of myth that's gotten traction in the last couple of years is that planting trees in order to neutralize fossil emissions is the first priority and what we all need to be doing. And while Amy's correct that I'm certainly a supporter of the Science-Based Targets Initiative, and my organization is one of the partners that implements it, I'm afraid that this emphasis on tree planting has come from a misunderstanding of the SBTI's corporate net zero guidance. And the figure to the left is the stylized trajectory of emissions reductions on the pathway to net zero for any company and the need to set targets and aggressively decarbonize. And the little purple bars towards the end of that trajectory below the zero line are the need for removals to neutralize any residual fossil emissions. But I think a lot of companies have misunderstood this to mean that only removals count. So if we're investing in carbon credits, they have to be only removals. And so if they're from the land sector, they have to be planting trees rather than emissions reductions from protecting forests. But that is certainly not the case, and certainly not yet. The reality is that it's most urgent to protect the forests we still have standing. And when a forest is cleared or burned, and especially a high carbon dense tropical forest, that immediately releases a huge pulse of carbon dioxide into the atmosphere that's going to be sticking around for a long time. And yet, even if we were to replant or restore that same area of forest right away, it could take up to 100 years or longer to restore the carbon density that we had just sent up into the atmosphere. And yet our timeline for getting to net zero is more like 30 years in mid-century. So any of the carbon that's released from destroying a natural forest or other carbon dense ecosystem is essentially irrecoverable in the relevant time frame. So while yes, we urgently need to be restoring forests that have been damaged or destroyed, we shouldn't be doing that at the expense of protecting the forests that we still have. The third myth is that crediting individual projects is sufficient to solve this problem. Now, it's true that virtually all the tropical forest carbon credits currently on the market are from project scale activities, some of which are extremely worthy and doing a good job, and that such local level activities will always be necessary in order to generate emissions reductions and removals. However, under the Paris Agreement, forest sector mitigation is accounted for at the scale of entire countries, or at least on an interim basis, large subnational jurisdictions such as states and provinces. And as well, leading public and private initiatives in this space have called for a rapid shift of demand towards jurisdictional scale credits. And that includes the LEAF Coalition, launched by President Biden a year and a half ago on Earth Day, and something called the Tropical Forest Credit Integrity Guide that represents a number of leading environmental organizations, including my own, and a leading Indigenous Peoples Federation. Well, why would they be calling for that transition? Well, the reality is that incentives and action are needed at large scale and large jurisdictional scale. Figure on the left, a stylized depiction of a scattered set of standalone projects in a landscape, whereas on the right, the crediting, the accounting for carbon emissions, as well as the actions to reduce them are taking place at a much larger geographic scale. The projects on the left are more vulnerable to some of the risks I mentioned earlier in terms of leakage. Preventing deforestation in one place just shifts, down the road a bit to another place. The vulnerability to reversals from a local forest fire, for example. But to me, the biggest reason for shifting to jurisdictional scale crediting is that it incentivizes governments to do what only governments can do. Things like enforce the law. Most deforestation is illegal. Recognize indigenous rights, most of which are not yet recognized, and also shift economic incentives through taxes and fiscal policies to make it more profitable to protect a forest rather than to destroy it. So let me close by just mentioning briefly the so-called John Oliver challenges, and I call them that because the HBO comedian dedicated an entire show last month to ridiculing the carbon market in general and forest-based carbon transactions in particular. And arrayed around his picture are a number of the headlines that we've seen over the last couple of years that embody critiques of trade in forest carbon credits. So in order to meet those critiques, we really got to double down in ensuring that we are able to assert with evidence that the very real supply side and demand side integrity risks are being adequately managed. So on the supply side, that means that carbon credits need to be independently verified to embody environmental and social integrity. And that means that they are reducing emissions from the perspective that the atmosphere sees, while at the same time not only not harming, but enhancing the rights and livelihoods of indigenous and local communities and enhancing biodiversity. But on the demand side, and this is critical because this is an issue with all carbon markets, not just forest carbon credits, although often forest carbon credits are used as the poster child, and that is the use of credits for greenwash. And in order to avoid that greenwash, corporate buyers need to be on a mitigation pathway aligned with limiting warming to 1.5 degrees Celsius as promoted by the Science Based Targets Initiative. and its use of carbon credits to back up any climate claims, like being carbon neutral or a net zero company, have got to supplement and not substitute for an ambitious and aggressive pace of emission reductions, both within and the extent within their operations and the extent of the value chain. There are a number of initiatives working to establish those norms. One of them, Amy mentioned, the Voluntary Carbon Markets Integrity Initiative. And so I think these norms are going to be established pretty soon. I've used lots of resources embodied in the publications shown on this screen, and happy to follow up with anybody later on to point you to the right resources that may be useful to understanding more of these points better. Thank you.
Perfect. Even a couple minutes early. Francis, I saw that there is a chat that a question that popped up in Q&A, and I'm curious if you saw it and maybe want to take a moment to answer it with the last couple minutes that we have here. Then we can shift on to the second session.
The one about the capital needed to reverse deforestation?
Whichever you prefer. I see.
Okay. Yeah. No, it's a really great question. And in fact, one of the reasons REDD+, the mechanism under the UNFCCC for reducing emissions from deforestation and forest degradation, is that forest-based emission reductions were seen as among the cheapest mitigation options. And calculations have been done showing that, in fact, because some of these drivers of deforestation can be addressed with relatively small out-of-pocket costs, which, say in the case of Brazil would be law enforcement effort, that emission reductions could be achieved at less than $5 per ton, compared to some of the prices in the market. However, those kinds of analyses, I think, do not take into account the real sort of political economy of what drives deforestation in terms of where the costs and benefits of land use change accrue. And in many countries, there are pretty significant vested interests in deforestation as usual that accrue more to the capital city-based commercial elites and not to local communities. So part of what REDD+ finance does is not only provide a financial incentive to undertake the actions that we know can work to reduce deforestation, but also to shift the political economy in ways that incentivize governments to undertake those measures and share the benefits with indigenous and local communities. So it's a short answer to a very complex question. Yes, there is some capital involved in setting up forest monitoring systems, and the restoration agenda is much more expensive. It takes a lot of capital to plant the trees and nurture them. But overall, it's really shifting the political economy incentives that really currently are driving land use change.
Fabulous. Thank you, Francis. Thank you, Amy, as well. Both of you, you had a tough assignment giving an overview in history in 30 minutes, but I think you did. So congrats and much appreciated.
Thank you.
As just a reminder to everybody, this conversation, all conversations will be recorded and made available online. We'll circulate a link via email. So if you are wanting to view anything asynchronously, you'll have the opportunity to do it.